Yo, 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 what's up, everybody? Welcome back to the channel. It's your stock whisperer, the guy who reads the market's mood swings like it's a group chat at 2 a.m. And listen, if you thought 2026 was going to start calm and responsible, nah. The market kicked the door in like, surprise, we're doing chaos, but make it bullish. Because this week, we had stocks printing fresh record highs like it's a hobby, small caps waking up from a 2-year nap and choosing violence. Bitcoin doing that thing where it flirts with a big number then acts shy. Gold shining like it knows something we don't. And a bunch of headlines that sound like they were written by a screenwriter who got fired from a Netflix thriller. So here's what we're doing today. I'm going to break down what mattered, what didn't, where money rotated, and what the market is pretending not to be scared of. And yeah, we're going to talk about the Fed, tariffs, CPI, earnings season, the whole buffet. Quick ground rules before we cook. I'm not your financial advisor. I'm your financial instigator. I bring the heat, you manage your risk. Deal? Deal. All right, deep breath. Because the first story, the one that hit the tape and made energy and defense stocks start acting like they just drank pre-workout, is what the U.S. just did in Venezuela. And when I say did, I mean did. Let's get into it. All right, so with all that as the backdrop, let's zoom in on the headline that actually kicked this whole week into motion, the one that quietly flipped switches all over the market. Because this wasn't just another geopolitical blip scrolling across the bottom of CNBC. The U.S. made a bold move in Venezuela, and bold is putting it lightly. This wasn't a press conference. This wasn't sanctions. This was a full-on operation. Nicolas Maduro was captured. Yeah, that Maduro. Now pause right there because moments like this are rare. And when they happen, the market tells you exactly how it feels. Not with words, but with money. Did stocks panic? Did we see a flight to cash? Did the market slam the brakes? Nope. What we saw was rotation, fast and intentional. Energy stocks caught an immediate bid. Defense names ripped to fresh all-time highs. Small-cap industrials? Suddenly moving like someone flipped the lights back on. And that reaction matters more than the headline itself. Because the market's first instinct wasn't fear, it was opportunity. Wall Street instantly started running the mental math. What does a post-Maduro Venezuela look like? And here's why that question is so powerful. Venezuela holds the largest proven oil reserves in the world. Bigger than Saudi Arabia, bigger than anyone. And for years, that oil has been effectively trapped, locked behind sanctions, political dysfunction, and infrastructure decay. So the second this news hit, capital started flowing toward the companies that would actually benefit if Venezuela were to reopen, rebuild, and reintegrate into global energy markets. And notice something important here. The big oil giants didn't lead this move. Exxon? Flat. Chevron? Meh. Instead, the money rushed into oil field services, pipeline and logistics names, refiners, especially along the Gulf Coast, niche drilling and infrastructure players. Because reopening an oil powerhouse isn't a switch you flip. It's a multi-year rebuild. You need equipment. You need engineers. You need security. You need capital, which is also why defense stocks took off. Anytime geopolitical risk rises and the U.S. signals a more aggressive global posture, defense names don't ask questions. They just start climbing. But before anyone runs off chasing every ticker with oil in the name, let's keep this grounded. This is not oil gushing tomorrow. This is not instant supply flooding the market. And this is definitely not risk-free. Venezuela's infrastructure is damaged, political stability is not guaranteed, and geopolitics never move in a straight line. The initial excitement in energy services and defense makes sense, but the real winners will be determined by follow-through, contracts, capital spending, and actual cash flow. And here's the subtle shift most people missed. While all this was happening, last year's darlings took a breather. Mega-cap tech? Sideways. AI chip names? Flat. Even with all the CES hype, the market said, cool, but not right now. That's not bearish, that's a healthy rotation. Money didn't leave the market, it just moved from overcrowded trades into under-owned real economy plays. And that's exactly what you want to see if a bull market is going to last. Now, one last thing before we move on. If equities were celebrating, gold was quietly nodding from the corner like, yeah, I see the risk. Because moves like this don't happen in a vacuum. China had deep ties to Venezuelan oil. Russia has interests in the region. And second-order effects have a habit of showing up when markets least expect them. So this Venezuela move? It's not just a headline. It's a signal. A signal that geopolitics are back in the driver's seat, that leadership in this market is shifting, and that the bull run is evolving, not ending. And speaking of unresolved risks, the next story isn't loud. It's not dramatic. But it might hit portfolios even harder. Tariffs, the Supreme Court, and a decision that's still hanging in the air. Let's go there next. All right. So while Venezuela was the shock headline, the next story is the kind that doesn't scream, but it lingers. The kind of thing the market keeps in the back of its mind while pretending everything's fine. And that is tariffs. Specifically, Trump's 2025 tariffs and a Supreme Court decision that everyone expected last week and didn't get. Here's what happened. The Supreme Court was supposed to rule on whether those broad emergency power tariffs stay in place or get tossed. Instead, they hit pause. No decision, no clarity, just uncertainty. And that uncertainty matters more than most people realize because we're not talking about pocket change here. We're talking about roughly $133 billion in potential tariff refunds and import costs that are still hanging in limbo. Now let me ask you something. If you're a manufacturer, a retailer, an auto supplier, or anyone relying on imported components, how do you plan next quarter when you don't know whether your costs are about to drop or stay elevated? Exactly. You don't. You wait. And markets hate waiting. But strangely enough, this time around, they've been eerily calm. No panic selling, no big positioning either way. Even Bitcoin barely flinched. Which tells me one thing loud and clear. This risk is being underpriced. Because this tariff decision is a legit fork in the road. Let's walk through both paths. Scenario 1. The court strikes the tariffs down. If that happens, that's basically a stealth tax cut. Import costs fall, margins improve, consumer prices ease, retailers, industrials, auto names, and tech hardware companies would likely rip higher. Inflation expectations would cool, the dollar could weaken a bit, and suddenly the Fed has less pressure to stay hawkish. That's a straight-up risk-on catalyst. Now flip it. Scenario 2. The tariffs stay. If they're upheld, then higher import costs are here to stay, and that means stickier inflation, more pressure on margins, less flexibility for the Fed. And remember, markets are currently priced for a friendly Fed, not a stubborn one. In that scenario, you could see equities wobble, bond yields creep higher, and sectors that rely heavily on global supply chains take a hit. Here's the part that really gets me. The market is acting like this decision is no big deal, but it touches everything. Inflation, earnings, Fed policy, the dollar, global trade relationships. That's not noise, that's macro, and the longer this drags out, the more potential energy builds up. When the ruling finally drops, the reaction is likely to be fast and violent, because positioning is light and complacency is high. Algorithms won't wait. Funds won't debate, they'll react. So this tariff saga? It's a sleeper issue. Quiet now, but capable of whipsawing markets the moment clarity arrives. And the wild part? This all feeds directly into the next topic, because tariffs, inflation, and Fed policy are all tied together. Which brings us to the question every investor is really asking right now. Is the Fed actually done? Or is the market getting ahead of itself? Let's talk about that next. All right, Now we get to the part of the story where the market starts getting a little too comfortable with itself. Because if you look at price action alone, you'd think everything is perfect. Stocks are up. Volatility is asleep. Risk assets are acting like the Fed already stamped mission accomplished on inflation. But when you zoom out just a bit, the data tells a much more complicated story. Let's talk about the Fed, the economy, and why complacency might be the real risk right now. We just got the December jobs report, and it was the definition of mixed. Payroll growth slowed to a crawl, about 50,000 jobs added. That's cooling, no doubt. But at the same time, the unemployment rate actually ticked down to 4.4%. And wages? Still growing. So what does that tell us? The labor market isn't overheating, but it's also not breaking. From the Fed's perspective, that's enough to justify hitting pause. Remember, we already had 3 rate cuts in late 2025. The Fed did its part. Now it wants to sit back, watch inflation, and make sure it doesn't flare back up. And futures markets agree, mostly. Right now, the market is not expecting a cut at the January 27th to 28th meeting. But here's the twist. The market does expect more cuts later in 2026. So we're in this weird Goldilocks zone. Growth is okay. Inflation is cooling, kind of, and the Fed is assumed to be friendly. That assumption has been absolute rocket fuel for stocks. You see it in the sectors that are suddenly alive again. Financials are ripping. Lower short-term rates plus a steepening yield curve means better lending margins. Banks love that setup. Home builders are catching a bid as mortgage rates ease. Small caps, which were crushed when rates were high, are suddenly breathing again. And honestly, there aren't many outright losers in this environment. It's more about relative performance. Defensive stuff like utilities and staples are lagging because nobody wants safety when the party's still going. But here's the part that should make you squint a little. Volatility is near historic lows. The VIX is asleep. Stocks are rallying through political chaos. Risk premiums are thin. That's not confidence, that's complacency. Inflation is not dead, not even close. Core inflation has been running around 0.3% month over month, which annualizes way above the Fed's 2% target. And next week's CPI could easily come in hot. If that happens, if inflation reasserts itself while unemployment stays low, the Fed may have to push back hard against the market's easy money fantasy. And markets are not positioned for that. That's why this moment feels fragile. Investors are betting on a perfect landing, steady growth, falling inflation, and a Fed that gently cuts rates without drama. It's possible, but it's not guaranteed. And when expectations get this clean, even a small data surprise can shake things up. So, big takeaway here? The rally makes sense. The rotation makes sense. But the lack of fear doesn't. And that brings us to the part of the story markets are trying hardest to ignore. Geopolitics. Because while stocks are partying, the world is getting interesting. Let's talk about that next. All right. Now let's talk about the thing the market keeps scrolling past like, yeah, we'll deal with that later. Geopolitics. Because whether Wall Street wants to admit it or not, the background noise right now is getting louder, and it's not just noise anymore. Think about this week for a second. The U.S. didn't just posture, it didn't just threaten, it acted, in Latin America of all places. At the same time, we've got talk coming back, yes, back, about the U.S. potentially buying Greenland. I know it sounds like a meme, but underneath the jokes is something very real. Resources. Greenland is rich in rare earths. Venezuela is rich in oil, and what you're seeing is a pattern. The U.S. asserting itself more aggressively around strategic resources, trade routes, and supply chains. Now here's the wild part. The stock market barely blinked. Outside of defense stocks and a few niche energy names, broad indices shrugged and kept climbing. The S&P just said, "Cool story, new highs." But if you look under the hood, not everyone is that relaxed. Gold keeps grinding higher, flirting with record levels. It's up more than 60% over the past year. That's not hype, that's hedging. Silver has been even stronger, which usually means people are thinking about both inflation and risk. And earlier this week, we even saw quiet strength in the Japanese yen, another classic safety tell. So what's going on? We've got a split personality market. On the surface, stocks say everything's fine. Volatility says nothing to worry about. Risk appetite is maxed out. Under the surface, precious metals are whispering caution. Certain currencies are hedging. Smart money is buying insurance. That tells me the calm we're seeing isn't confidence, it's selective blindness. And historically, that doesn't last. Moves like the Venezuela operation don't exist in a vacuum. There are second and third order effects. China was a major Venezuelan oil customer, now displaced. Europe could bristle at Greenland chatter. Other oil producers may respond strategically. Any one of those threads can turn into a headline that markets can't ignore. Right now, volatility is priced like nothing bad can happen, and that's exactly when something usually does. So here's the key takeaway from the geopolitical angle. Markets are filtering hard right now. They're separating signal from noise, but they may be filtering out real risk along with the noise. This doesn't mean sell everything. It means don't be asleep at the wheel, because we're one bad headline, one sanction, one surprise decision away from a sentiment shift. Which brings us to the big question. Given all of this, stocks ripping, volatility asleep, geopolitics heating up, what does this actually mean for risk appetite, volatility, and market leadership right now? Let's put it all together next. All right, let's put all the pieces on the table and talk about what this market is really saying right now. Not with headlines, but with behavior. Because when you strip away the noise, the message is actually pretty clear. Risk appetite is high, very high, and not in a subtle way. You see it everywhere. U.S. stocks at record highs, European markets printing all-time highs, small caps exploding out of the gate in January, credit spreads tight, Bitcoin knocking on the door of six figures. This is a full-on risk-on environment. But, and this is a big but, it's a risk-on environment that's still running on Fed life support. Markets are comfortable taking risk because they believe the Fed has already pivoted and won't pull the rug out from under them. 3 rate cuts in late 2025 bought a lot of goodwill. Liquidity is still sloshing around the system, and that liquidity needs somewhere to go. And right now, it's going into equities, especially the parts of the market that were left behind. Which brings us to something important. Leadership is broadening. This is one of the healthiest signals we've seen in a long time. Last year, it was all about the same handful of mega-cap tech names. If you weren't in them, you felt like you were doing something wrong. Now, different story. Small caps are leading. Financials are leading. Industrials, defense, materials, leading. The Russell 2000 surged more than 6% in the first week of the year, crushing large caps. That doesn't happen in fragile markets. That happens when investors are confident enough to move down the risk curve. And that's a big deal. Because when participation broadens, bull markets tend to last longer. They become less dependent on a single narrative, like AI, and more rooted in the real economy. But let's not get carried away. Volatility is low. Almost too low. The VIX is hugging the floor. Realized volatility is muted. Liquidity is smooth. Bid-ask spreads are tight. That's great, until it isn't. Low volatility doesn't mean low risk. It often means compressed risk. When everyone is calm, positioned similarly, and selling volatility for yield, it doesn't take much to trigger a spike, a hot CPI print, a surprise court ruling, a geopolitical flare-up. And when that happens, the move can be sharp because nobody's hedged. Now, on the constructive side, the yield curve is steepening again. The 2-year yield is well below the 10-year. That's a sign markets are no longer pricing imminent recession. It helps banks. It helps lending. It improves liquidity across the system. So we've got this interesting setup. Liquidity is good. Risk appetite is strong. Market leadership is healthy. But volatility is artificially suppressed and complacency is creeping in. That's why I'd describe the current environment like this: risk on, but not reckless; confident, but fragile. And that sets the stage for what matters most on a sector-by-sector basis, because this isn't a buy-everything market anymore. It's a rotation market. So next, let's zoom in and break down where money is flowing and where it's quietly taking a breather. Let's talk sectors. All right, let's zoom the lens in and get surgical, because this is where a lot of people get chopped up. This market is not rewarding laziness anymore. It's not buy the index and go make coffee. It's rotation, selection, and timing. So let's break down who's leading, who's resting, and who's quietly setting up. AI and semiconductors. Neutral, cooling, not cracking. Let's start with the crown jewel of 2025. AI and semis had an insane run last year. Legendary, historic, the kind of move people will reference in future podcasts. But this year, the market is saying, take a breather. Nvidia, AMD, the big names, flat on the week. Even after all the CES buzz, the market yawned. And that's not bearish, that's digestion. Valuations are full, expectations are sky high. The bar is no longer good, it's perfect. Now here's the nuance most people miss. While the giants paused, the picks and shovels players moved. TSMC came out with a strong earnings report, and suddenly, ASML pops. Equipment suppliers catch a bid. Smaller niche chip names start getting attention. Translation? The AI theme is alive. Money is just being more selective. Long-term, AI is still a megatrend. Short-term? Neutral. Let earnings and guidance do the talking. Energy? Neutral. Price weak, activity strong. Energy is a tale of two stories right now. On one hand, oil prices got smacked. Brent dipped below $60. WTI ended the week in the high 50s. Why? Because the market thinks Venezuelan supply is coming back faster than reality probably allows. On the other hand, energy equities didn't roll over the same way. Why? Because this isn't about oil prices, it's about activity. Oil field services, refiners, and infrastructure names are catching bids because more drilling, more transport, more refining, more rebuilding. Especially Gulf Coast refiners who could get access to cheaper heavy crude. So here's the stance. Bearish short-term on oil price itself. Constructive on services, refiners, and activity-driven names. That's why we call it neutral overall, but with very specific pockets of opportunity. Financials. Bullish. This one's clean. Financials are loving life right now. Lower short-term rates plus higher long-term rates equals fatter margins. Credit conditions are improving. Loan growth is modest but positive. And the market is front-running earnings season. Regional banks that were left for dead? Ripping. Fintech names? Catching a bid. Even crypto-exposed financials are perking up. Earnings kick off next week, and expectations are reasonable, not euphoric. As long as credit doesn't crack, the path of least resistance for financials is up. This is one of the strongest setups in the market right now. Small caps versus large caps. Small caps leading. This might be the most important shift of all. Small caps are finally getting their moment. They're cheaper. They're more domestic. They benefit more from rate cuts. And they were massively under-owned. We've got a valuation discount of roughly 26% versus large caps. A strong January effect. Real fundamental tailwinds. Large caps aren't broken, but they're resting. Their leadership role is fading for now. If the economy holds up, small caps can keep running. Just remember, they swing harder both ways. Growth versus value. Value has the edge, for now. This is the style shift people are slowly waking up to. Growth dominated 2025. Value is waking up in 2026. Why? Because rates are off their highs. Inflation risk still exists. Cash flows matter again. Financials, industrials, defense, materials, classic value and cyclical names are outperforming. Growth isn't dead, not even close. But at 30 to 40 times earnings, growth stocks have no room for mistakes. Value names? They've got cushion. So near term, the edge goes to value, especially in a world where inflation might prove sticky. So what's the takeaway from all this? This is a thinking market. Rotation over momentum. Cash flow over hype. Selection over spray and pray. And that brings us to the question everyone cares about. What happens next? Short term? Medium term? What's the roadmap? Let's talk outlook. All right, let's look forward because this is where expectations meet reality and where markets either stay smooth or get a little bumpy. We'll break this into short-term and medium-term because the vibes are very different depending on your time horizon. Short-term outlook. Reality check territory. Over the next few days to couple of weeks, odds are high that the market gets tested. Not because the trend is broken, but because too much good news is already priced in. We've got a stack of catalysts coming up fast. CPI next week. This is the big one. If core CPI prints hot, anything north of that approximately 0.3% monthly pace, the market's "Fed's got our back" narrative gets challenged immediately. And if that happens, stocks pull back, bonds sell off, volatility wakes up. Not a crash, but a reminder. On the flip side, if CPI comes in cooler, that Goldilocks story gets reinforced and the rally can stretch a bit longer. Earnings season begins. Big banks kick it off, JP Morgan, Citi, Bank of America. The market's going to be listening closely for consumer stress, credit delinquencies, loan demand, commentary on tariffs and costs. Early earnings tend to set the tone. Any disappointment could spark a quick 3 to 5% dip, especially with positioning this relaxed. The Supreme Court tariff decision. This thing could drop at any time, and because nobody's positioned aggressively, the first reaction is likely to be sharp. That's why, short-term, the risk is skewed slightly to the downside, not because the bull market is over, but because complacency is high and catalysts are stacked. A pullback here? Totally normal, even healthy. Medium-term outlook. Cautiously constructive. Zooming out a few months, the picture actually looks pretty solid. The bull case still has legs. The Fed is done hiking. Policy is at least neutral, if not supportive. Earnings growth is expected around 15% in 2026. Market leadership is broadening. Small caps are participating. That's a much healthier setup than last year's narrow rally. We don't expect a straight line higher. We do expect more volatility, more rotation, and more stock picking. And honestly, that's how sustainable bull markets behave. Now let's talk risks, because there are always risks. Inflation is the big one. If it refuses to cool, the Fed's cutting cycle stalls, and that could trigger a deeper correction. Geopolitics is the wild card. Trade tensions, resource nationalism, or an unexpected escalation could hit sentiment fast. But in our base case, growth slows gradually. Inflation cools slowly. The Fed stays patient. That's a soft landing, and markets can live with that. In that world, we could see single-digit gains in the S&P from here, continued outperformance from value and small caps, tech consolidating before the next leg. So the medium-term message is this: bull market intact, but the easy money is gone. This next phase rewards discipline, not hype. And that leads us to the final part of today's breakdown. What should you actually be watching next? Let's close it out with that. All right, let's land the plane by talking about what actually matters next. The stuff that can move markets in real time, not just make good headlines. Because the next couple of weeks, they're stacked. What to watch next? The market's tripwires. U.S. inflation data, CPI, January 13th. This is the main event. Everything right now, stocks, bonds, crypto, rests on the assumption that inflation keeps drifting lower. Watch. Core CPI, especially services. Any signs wages are bleeding into prices. A cooler print reinforces risk on. A hot print? That's when volatility re-enters the chat. The market will react fast. No debate, no nuance, just movement. Q4 earnings season kickoff. Banks go first, and they matter more than people think. JP Morgan, Citi, Bank of America, these guys are economic weather vanes. Listen for consumer spending health, credit card delinquencies, loan demand, corporate confidence. Earnings aren't just about numbers, they're about guidance. If CEOs sound cautious, markets will notice. Supreme Court tariff decision. This one's still hanging over everything. It's rare for a court ruling to be a market catalyst, but this one absolutely is. Trade-sensitive sectors could swing hard. Industrials, retail, tech hardware. When the decision hits, expect algo-driven moves, currency reactions, inflation expectations to shift. Be ready. This won't be subtle. Central banks and global signals. We're heading toward the late January Fed meeting. No rate cut expected, but tone matters. Any pushback against easing expectations could shake things up. Also keep an eye on Bank of Japan policy signals, ECB commentary, global bond yields. Markets are global now. Liquidity doesn't respect borders. Geopolitics and policy moves. Watch follow-through on Venezuela oil contracts, defense spending chatter, trade policy headlines. And domestically, infrastructure talk, budget negotiations, fiscal stimulus rumors. Policy equals capital flows. Market stress signals. This is where you separate noise from danger. Watch. Credit spreads, yield curve behavior, volatility indices, sudden spikes in bond yields. So far, stress is low, but that can change quickly. Final takeaway. Here's the bottom line. The market is optimistic. Liquidity is supportive. Leadership is healthier than it's been in years. But expectations are high, and patience is thin. This is not the moment to be reckless. It's the moment to be aware. Opportunities are there, but so are tripwires. So stay sharp, stay flexible, and don't confuse calm markets with safe markets. We'll see how this all plays out over the next week, and you already know I'll be right here breaking it down with you. If this helped you think clearer about the market, hit that like button, subscribe if you haven't already, and drop a comment with what you're watching right now. I'm the Stock Whisperer, and remember, when the market gets quiet, that's usually when it's about to move. All right, before we fully wrap this up, let me leave you with the mindset you should be carrying into the next stretch of this market, because information is useless without perspective. Here's the trap a lot of people are about to fall into. They're going to look at record highs, strong breadth, small caps ripping, volatility asleep, and assume this is easy. It's not. This phase of the market is more dangerous than the panic phase because confidence replaces discipline. Right now, the market is basically saying, I believe in the soft landing. I believe in the Fed. I believe nothing goes wrong. And whenever belief gets that clean, reality likes to test it. That doesn't mean you run for the exits. It means you tighten up. This is a market where you respect trends, but you don't chase breakouts blindly. You buy dips in strong sectors, not random hype. You take profits when things get stretched. You keep dry powder for volatility spikes. Rotation is your friend right now. Money is moving, not disappearing. If you're still mentally stuck in a 2025 tech-only mindset, you're already behind. This market is rewarding balance, cash flow, real businesses, and patience. And here's the biggest tell of all. Even with stocks at highs, smart money is hedging. Gold isn't screaming, but it's not selling off either. That's not fear. That's respect for uncertainty. So if I had to sum up the market in one sentence, optimistic, liquid, and rotating, but one headline away from waking up volatility. And that's not bearish. That's just reality. All right, next episode we'll see how CPI hits, how banks report, and whether the market keeps pretending nothing can go wrong or finally blinks. Until then, protect your capital. Let winners run, but don't fall in love. And always remember, the market doesn't care how confident you are, it only cares how prepared you are. I'm the Stock Whisperer,